We have about over 100 products in our portfolio, and we're going to talk about few today, but we have a lot. We have 90,000 agents across the country, 55 employees, and 85 millions of policies and accounts. We are a mutual company, meaning that we always thinking about our customers, not the because our customers are our shareholders. About 60% of State Farm households have more than one product. And we actually, in 2020, did 22,000 claims per day. Small business insurer, leading insurer for watercrafts, and number 36 on the Fortune 500. So what is insurance? What kind of insurance do we offer? So our major lines is auto insurance, motorcycle, boats, recreational vehicles, home, condos, co-ops, renters, life, supplemental health insurance, annuities. And in business lines, we have general liability, workers' comp, and commercial trucks. It is limited to the states, so some states do one line or two lines, or temporarily don't do any lines. So it depends on when you call us and on our underwriting cycle. So insurance is what you own, what you earn, and what you owe. This is a car insurance. So looking at the car insurance, car insurance is a package of different coverages. So first thing, we're going to talk about the liability. This is something that everyone has to have on their car insurance. In New York, the minimum is 25, 50, 10, which basically means that if you hit another vehicle, 25,000 will be paid on for bodily injury for one person, 50,000 for one accident, and 10,000 is for property damage. It's the car that you hit. So it's a minimum to get the insurance, but most of the time, people have assets to protect. So getting into the accidents, they basically put those assets in danger because that person that they hit can sue them, and it can go against that person assets, against their salary. And in New York, it can be a 15% salary garnishing. So we ask the customer, how do you feel about not having 15% of your salary because of that accident? Or how do you feel about having a lien on your home because of that accident, right? So the assets that we work for, we have to make sure we're protecting. So for the homeowners, we recommend to have at least this coverage or higher. Again, it depends on the assets that the customer has. So we recommend to have at least 100,000 for bodily injury, because average day in a hospital is about $25,000 a day. So realistically, 4 days in a hospital for that person, this money will cover that. But if you have 25,000, it barely will cover 1 day, and potentially can be other things that person can sue you for. Right, 300, it will be paid for the liability overall. If there are more than one person, maybe there are 3 or 4 or something like that, that's the total limit. And the last one is the property damage, is 50,000 minimum that you want to put, because that's the average car that currently we have in New York and we see in New York. So basically, if you hit an average car in New York, this is how much you're looking. If it's that car that got a major damage, right? That person can sue you for. So instead of having that and be afraid that you're going to lose your assets, it's better just to have a correct protection on your liability. So just make sure you double check what you have. If you have a state minimum, you have nothing to lose. If you don't have any assets to protect, right? But again, if you're young and you're gonna plan to work and make money, right? That claim can follow you throughout, throughout your life. So you want to make sure you start good protection early on. So the next coverage is uninsured, underinsured. It's the coverage for you in case the other driver did not have insurance. So same thing, we do recommend to have it at least what you have for your liability, because this is protection for you. The other driver does not have insurance because, for example, they're driving from another state where they don't have that requirement and they didn't purchase that insurance. But so you want to make sure that you are protected. So I do see a lot of times that this coverage is overlooked, and a lot of times if the person has a 100, 300 on liability, they have 2550 here, which basically representing, and the customer might not understand why, but we are here to help them to understand that this is important coverage. It's not really expensive coverage, but sometimes it's lowered on the policy to lower the price, but it's not maybe adequate coverage for the customer, and because the customer does not understand. So we want to make sure they understand, and if that's what they want to do, if they want to have low coverage, that's okay too. It just they need to understand what this coverage is for. The next and very popular coverage is personal injury protection. So personal injury protection, everyone will get 50,000. This is no fault. That means if you get into the accident at your fault or not your fault, you will get up to 50,000. You also have this coverage when you are the pedestrian. So if someone hit and run, this is the coverage that will cover you. It does provide a deductible of 0, 100, and 200. So again, if you want to have a minimum coverage, right, a lot of times you just get the basic one, which is, it calls basic, but realistically it's 50,000. And then you get to choose $200 deductible. However, we do recommend to have this coverage to a maximum level, which basically meaning adding additional personal injury protection. It calls additional personal injury, and there you can choose a limit of 100,000, optional economic loss, which represent a limit of 25,000. So sometimes it can be just the verbiage, optional economic loss, but basically it's 25,000. It's a set limit. What else this coverage covers? It also covers the loss of income. The loss of income, it's up to $2,000 a month, up to 80% of the salary, up to 3 years. So if someone cannot work due to accident, and we're talking about people, again, inside of your car, it's going to be you or anyone inside of your car, and it's per person. So this coverage will be applicable, and they will get loss of income coverage up to the limits of their policy. You cannot increase it. This is a set limit, and it comes with every policy in New York. There is a other and funeral expense. So other, it's a $25 a day for other expenses, and funeral expense usually cover $2,000 per insured. That's if the person dies in the accident. The next coverage is coverage for your vehicle. So there are two types of the coverage. There is a type collision and comprehensive. There is sometimes collision calls other than comprehensive, which is basically collision. So the main difference is collision is when you hit another vehicle, any object, like for example, this is a pole. So those are collision. Anything else is comprehensive. Your car is flooded, it was stolen, you hit an animal, which is also comprehensive coverage. So each coverage has a deductible. Most of people choose to have $1,000 deductible because it's not worth to file a small claim. However, some people choose to have a 500 because it's low out of pocket. The higher the deductible, the lower the cost. The higher the deductible, the lower the cost of the insurance. So there is an optional coverage. Sometimes people say, I want full coverage, but full coverage means different things. So it's not only collision and comprehensive, but it's also additional things that can come with that. So there is a glass coverage, which means that there will be no deductible on the glass. So if we always suggest to have a glass coverage on, and that means if there is a broken glass, they just file a claim, they pay $0. Otherwise, if they don't have this coverage, they're going to be subject to comprehensive deductible. There is a roadside assistance, which basically covers you if you're stuck on the road, you need to change the tire, you need to unlock the car, or anything else during the accident, right? You need to tow your vehicle or whatever it is. So that's, you're going to need the emergency roadside assistance. Usually it's not very expensive, and it's recommended to have on the policy. The next coverage is death, dismembership, and loss of sight. So if the person is died during the accident, lose part of the body, they can get, in addition to their personal injury protection due to death, we have $2,000. But in this protection, they can get in addition $5,000 or $10,000. Usually not expensive. So we do suggest to have that addition on the policy, just in case it's a little coverage on the life insurance, or if the person lose part of the body, it also pays out 5 or 10,000, which does help obviously when things like that happen. There is also coverage for car rental and travel expense. So car rental will cover up to 80%, up to $1,000. And the travel expense, a lot of people don't know that we offer that, and it's part of the car rental. If the person travels away from their home 50 miles away, they will actually get paid for their hotel, meals, and transportation to their car repair place. And that will be the limit of $500. So now we're going to talk about the discounts. So the discounts in green, those can be applicable for every driver. The discounts in yellow, those can be applicable for the younger driver. So the discounts that not highlighted, this is usually has to do something with their vehicle, right? Or with the driver, and we cannot really, so that depends on the vehicle, whether they have alarm. The good driving discount that usually comes based on the driving record, and it's automatic in the system. The multi-car discount comes if they have 2 or more cars in the household, and the multi-line discount is something where they have an additional line with us, and we can talk about other lines later in this course. So the defensive driving class, it also calls accident prevention discount. You're going to see 2 verbiage, defensive driving class or accident prevention. It's very easy. In New York, you take a class for, you're taking a class for 6 hours, and it will give you discount for 3 years. The Drive Safe and Safe, it's a little device that mailed to your house. You activate it on the State Farm application. It gives you 10% upfront discount. Average is usually 12. It monitors how soft you drive, and the discount will be varies from 1 to 30%. And usually 2 months before the renewal, you will get notification that will prompt you to enter amount of miles in the State Farm app under the Drive Safe and Safe section. And after that, they will see how many miles you drove, and they will determine the discount based on your driving history and how many miles you drive during that time. The driving training is a class that again, we're talking now about the 25 and under. So driving training course is usually young adults that took the driving ed class in school, and they provide us with a certificate. The good student discount is anyone, if they graduate already or they are in school currently, anyone who has 3.0 or B average, they just provide us with a copy of their grades, and we are able to provide that to underwriters so we can qualify that discount. They might ask sometimes periodically to provide a copy of upgraded grades if they see that the student is in the process. So just to verify the discount, continuation of that discount. The Steer Clear discount is a State Farm course that the young adult will complete on the app, and it's 5 hour of driving and 5 hour of theory. So it actually goes 5 hour of theory and then 5 hour driving. It has to be at least 10 trips recorded. So the young adult goes from home to the store, from store to the school, from school home, etc. So each will consider as one trip, and it has to be at least 10 in, it has to be at least 5 hours. Doesn't matter how they do it. The major is they have to do 5 hour. And after that, the certificate is issued. It's very helpful for young adults because it helps them to understand about the driving, safely driving, and the State Farm promotes that. So we encourage them to actually do complete that course and not cheat, and encourage the parents for their kids to take that course. It does not have any penalty. They just need to complete it. That has to be completed within 30 days from the beginning of the policy. So student away discount at school, the student has to be 100 miles away from the home, and they don't take the car with them. It just, they are listed on the policy, and they just away from home, and they're coming back during the school break, and we are able to put that discount. Again, we need the verification, and that's basically it. Home insurance is very comprehensive coverage as well as the auto insurance. It includes few coverages. We're going to talk about each individual coverage. So the first coverage that you're going to see, it's a dwelling or building protection, and depends on the company, it wording differently, but means the same thing. It's how much it costs to replace your home. The other one, the next one is expanded replacement cost, which basically, if you have a deluxe policy, it protects, it gives you extra protection for your dwelling. So if the material or labor costs more, you actually, in this particular scenario, will have 80,000 to cover in excess cost if there is any at that point of the loss. The next coverage is extended dwelling coverage. It's basically anything that is detached from your home, which basically means if you have a shed or any type of structure that is detached, then you should be able to cover with the 10% of the dwelling coverage. In this particular scenario would be 40,000. There is an option to increase it, but a lot of people don't have the detached structure or have the detached structure that will cover within that particular limit. The next coverage is personal property protection. Usually, if it's a deluxe policy, it comes with a 70% of the dwelling amount. In this particular scenario, it is 300,000. What's important to know about the personal property that it comes with a replacement cost. So that means you will go and you will replace your item. As an example, you bought your furniture for $20,000 5 years ago, and now you have a claim. If you don't have a replacement cost, your personal property depreciate a lot, and now it costs probably $5,000. So you will get only this coverage. What is actual cash value means. So if on your policy it said actual cash value, so that means what it costs right now, including depreciation. However, if you do have a replacement cost and that furniture costs now 30,000, you just go to the store and replace your furniture with a brand new one, and you will get up to the limit. And usually that limit is enough to replace. Also to note about that coverage, if you have items such as jewelry, furs, watches, any type of expensive computers, or anything collection, some people have a wine collection, art collection, or so forth. You want to have a separate policy, which calls personal article policy, that you can set up as well. That because there is a limitation, for example, on jewelry, usually it's $5,000 on that coverage. So, oh no, actually, I'm sorry, 2,500 limit. So if you have any piece of jewelry or watches or whatever, you won't just do it on a separate policy, which calls personal article. The next coverage that you see is a medical coverage, which basically a part of the liability. The medical coverage is the first thing that's going to pay out. For example, you have a guest, it's slip and fall. The 5,000 will be paid out first, but then liability will pick up the medical bills and anything else. Maybe they cannot work or they have to go to a hospital and that it's excessive medical bills. So you're going to have liability. So it's very important actually to check this limit, and more important than this. And just make sure that the person has at least what they have for the dwelling or higher, because we want to protect the assets of the insured. So it's 500,000 in this particular case is the minimum that we would recommend. The last coverage is loss of use coverage. It will cover a temporary living during the claim. Let's say you had a fire in the house, so you need to live somewhere. And in this case, they will pay you for renting alternative place, such as hotel or anything like type quality home. If it's an extended period of time, if you need to stay somewhere for like few months, so they would probably pay for the alternative home to rent rather than a hotel. In some cases, it will also cover the food. Again, if you are staying in a hotel, you don't have a full kitchen, so they will pay difference between what you regularly spend on the grocery bill versus that you spend on the restaurants during the time that you are in a hotel. So As I mentioned before, the personal property replacement cost is very important, and it's not provided with every home insurance. So we always recommend to have that in place. Water backup coverage and service line coverage, those are additional riders that is important to have on the policy. So water backup, if the water backs up through the system, very common claim. It provides either 5 or 10% of the dwelling. So in the here, so if you do 5%, it will calculate it from dwelling. So it will provide 20,000 of coverage. And if we do 10%, it will provide 40,000 of coverage limit for the water backup. The service line is basically a coverage that will cover the service line from the home to the main road that is under the ground, and we don't see it because as a homeowner, you're responsible for that, and the coverage limit is 10,000. And scheduled jewelry or other valuables, that one is not part of the home insurance policy. You want to make sure that you have it as a separate policy. So with the homeowners, so the homeowners can be a condo policy or renter's insurance, right? We talk about the homeowners policy, but with the condo insurance, it's basically almost the same coverage. So the dwelling and building protection, here we have on the homeowners insurance, we have to make sure that this is a replacement cost. We're gonna use the replacement cost estimator tool to make sure that it's covered under. To make sure it covers the replacement cost, because if you don't, then you're going to be subject to co-insurance, meaning that if it costs $400 to replace this home and then you have a $300 coverage, you're going to be subject to co-insurance. You're going to have to come up with $100,000 before your home insurance pays anything. So you want to make sure you're not underinsured, and also you don't want to make sure you're not overinsured, because if you're overinsured, you pay for the coverage that you will never get. So if it costs $400, but because the market price is $600 or $700, because it's this area in demand, you still don't want to overinsure your home because it costs $400,000 to replace it, and insurance will cover how much it costs to replace the house, not how much it costs on the market. You can rebuild your house and sell it for whatever you want, but the insurance you should get for only things that only replacement costs to replace your home, how much it costs to rebuild. The other type of the homeowners policy is the condo. So here on the dwelling protection, you can choose what you want to have. You want to have 25,000, 50,000. So imagine you have a fire in your apartment, and in your apartment, you need to do renovation because you're responsible for anything inside. The building, the master policy will only provide you with a minimum coverage to just cover the walls. But anything it calls walls in coverage, means that you're responsible for anything inside. So if you have hardwood floor, if you have laminate, it's two different materials. So depends on how much you spend on the renovation of your apartment. So this is the coverage you want to have on your dwelling protection. Same thing on the personal property. You choose what you want. So you have 10,000 of personal property because you just move in and you're a young adult, right, who doesn't have anything much at the beginning. But as you live in that place and you accumulate the stuff, you want to consider to increase your personal property coverage accordingly to what you have. And liability, it also comes with that coverage. So again, the more assets you have, the higher liability limits is recommended. Loss of use is usually calculated. Same thing, it's your living expense, right? But it's calculated of the personal property. So the more personal property you have, the higher limit you're gonna see on the loss of use coverage. And that's basically it for the condo insurance. So in New York, there is a condo and co-op policies, which basically it's the same thing. It's just different type of ownership. Condo, you own the apartment. In co-op, you own the shares. But every policy, condo policy, will cover either homeowners. It will cover condo or co-op, regardless of the ownership type. It's the same type of the policy. Okay, we continue our session, and now we're going to talk about the umbrella coverage. Currently in New York, we don't offer that. We do have current customers with umbrella policy, but soon we're gonna open that door and we will offer the umbrella policy, which is essential for a lot of people because they need to protect their assets. So what is the umbrella coverage? Is excess liability. It's very easy coverage. It's basically if there is a big lawsuit, you hit a pedestrian, like we discussed on the car insurance, and that pedestrian is suing you for lost wages or excessive medical bills, etc. So your assets can be at risk, right? So you either have to pay to that person or you're going to have an umbrella policy that will pick up that excess liability. So how to qualify for umbrella? First of all, you have to have a decent limits on your I'm sorry, you have to have a decent record on your driving record. So you cannot have more than two accidents. And the other two portions of that, you have to have car insurance with State Farm with the minimum limits of liability of 250 per person, 500 for the accident, and 100 for the property damage. If you don't have your car insurance with State Farm, they will eventually they will charge you an extra fee and then eventually will cancel that umbrella. The reason is because 80% of the claims for the umbrella comes from the car insurance. So they want to make sure that you have car insurance with State Farm or doesn't matter on the company. If you have insurance, a car insurance with one company, umbrella is encouraged to have with the same company. So in another thing, you have to have all, it's not only car insurance, it can be motorcycle insurance. So any type of vehicle has to be insured with State Farm. If it's not, then it's going to have a surcharge. So those are two things. And then regarding the home, most of homeowners have this 300,000 liability coverage on their home. So it's usually not a problem. And yeah, so that's the last requirements how to obtain the umbrella policy. The limits for the umbrella policy starts from $1 million and it can be easy approved up to 5 million. Extra over 5 million will require a certain approval from the underwriter. So we have to show that you have those assets to protect, and they review it, and usually it's getting approved, but it just takes longer time. All right, so we're moving next to the life insurance. So the life insurance, this is the slide. It's my favorite slide. It calls liability curve. It's basically a policy for the family, right? We're getting this life insurance for the family. So this is our life. We don't know when it ends, right? And this is in the arrow, that's the estate that we pass into the family. And this is our liability curve. We buy in the house, we having kids. So our liability somewhere at the top, this is the highest liability when everyone depends on your income. And if, God forbid, something happened to that breadwinner, then this is the liability responsibility, financial responsibility of the family that they will have to come up with a certain amount of money to cover that liability, whether it's income, whether it's paying off the mortgage or something like that. Eventually, the mortgage gets paid, the children growing up and become financially independent, and that liability is not as high. So for that type, you can be somewhere here, you can be somewhere there, you can be somewhere here. So different situation is for every customer. So for some people, they need a term 10. For some people, they need term 20 or term 30. So it doesn't matter where you are in the curve, but it's just a temporary thing. That's why we recommend to have that temporary lift of coverage, right? We offer two types of the term insurance, which is a regular term, which basically you pay and you have the coverage. Your rate is fixed for 10, 20, or 30 years. And then the other type of the term is return of premium, ROP term. So that means the premium is returned. So at the end of the term, all the premium that is paid towards the policy, including the rider's cost, will be returned to the policy holder. Those terms are 20 or 30 years. They don't offer that on the term 10, only for 20 or 30 years. It's very common to have a return of premium policy for high earners individual that care about return of their money. They have that temporary liability, but at the end, they want their money back. It's also very common in the business owners. Usually, buy-sell agreements are structured with a return of premium. Buy-sell agreement, let's say we have two partners in the business and one partner die. So that family of that partner who died will get, let's say, $1 million. And on the other hand, the second partner who survived will keep the business. So the return of premium usually the businesses choose to have that return of premium because at the end they're getting all the premium back at the end of the term if nothing happens. Of course, if there is if someone dies, nothing gets returned, but nothing happens, they will get all the money back. Um, on the bottom, this is the whole life policy. So this can be a final expense policy. We have policies with a 10 or 15,000 for anyone 50 to 75 years old. There is no medical, the price is fixed. It's there until basically the person dies, and it pays for funeral expense because right now minimum cost of the funeral is 10 to 15,000. It can be obtained anytime from 50 to 75. There's no approval. You basically sign the application and it's issued the day off, and the person has the coverage the day off. The requ so For anyone under 25 or under 50 years old, they can get a whole life policy with a minimum of coverage of 25,000, which will have a feature of growing. So the longer the person lives, the higher the benefit will be. They can start with a 25,000, but at the end of 20 years, usually it's going to be maybe 40,000. Or but based on the illustration, we're going to see how much possible value will be based on the current policies. So the whole life policy is also used to transfer the estate. So if people want to give to the next generation 100,000, 200,000, 300,000, or whatever it is, so they can put a lump sum, and the person has to be reasonably healthy because it will require underwriting, but it's a big a lot of times people use those policies to pass to the next generation. It can be single premium life insurance. It's going to be still whole life policy. The person puts one lump sum, or that lump sum can be actually put into the account. We can do pay 10 policy, which basically means that this money is going to be in the account, getting the it. So with the pay 10 policy means that they put a lump sum, they can put in 10 years certain amount of money. But if they choose to put a lump sum, they're going to put less of the premium compared to that premium if they pay every year. So for example, if their premium is $2,000 a year and they pay for 10 years, in 10 years, they would pay for this policy $20,000. But if they put a lump sum, most likely it's going to be 18,000. We're going to have to see on the illustration what amount it will be if they pay in lump sum. So if they pay that money in the lump sum, basically they hold into the account and provide some kind of interest or dividends that makes this make it paid for each year during those 10 years. The benefit of that type is if God forbid something happened to that person during those 10 years. So besides the death benefit that's going to pay out to the family, also unused premium is going to pay out. And you can do the same thing, pay 20. So spread that amount into 20 years. And same thing, if something happened during 20 years, the death benefit plus unused premium will be returned to the family. Or you can just go with a regular whole life policy where you pay and we customize it based on the budget for the customer. Minimum, we will start with the 25,000, but you can do a lot more. Usually, I ask the customer how much they put into the savings and show them what they can do if they put portion of those savings into the whole life policy, what it can do for them. Because the advantage is the cash value is accumulated into those whole policies. We can put a limit of how long they will pay this policy, let's say for 20 years or until they're 65, 67, whatever it is, right, the retirement age. So they're done with paying that policy off during that time. And then or during that time, if they need the money to borrow, they can borrow against that policy. There is an interest assigned, which is like a basically interest that is a current interest rate. And any money that if they choose to pay back that policy, it's going to go back basically to the account and ultimately to the beneficiary. Or they might not even return it back. Some people don't return it back, and it's okay. So they use the money. They basically they can even take more money that they put into the policy. Depends when they started, and we have to see the cash value in the account. But in most cases, if you start early, the whole life policy, there will be more money into your cash value compared to the premium that you paid into that. So if you take, as long as you take up to 80%, the policy is not surrendered. You not mandated to return that loan. And when the person pass away, then it's going to be whatever the insured person took, it's going to be subtracted from the death benefit minus those interests that the person owe during that time. So we will have to run illustration for each individual customers, but basically to understand the whole life policy is something that goes to your family, doesn't matter what, builds that cash value and last all life, right? The term policy provides usually the temporary benefit, right? The temporary heal of liability that a lot of family facing. So that's basically it about the life insurance policy. One thing that I would mention, very common riders that whole life policy have. First one is a waiver of premium for disability. I would highly recommend to add that rider on. So that means if the person is disabled, they don't have to pay for the premium. So the premium is paid by itself. And if it's a term policy, so the term policy basically it means that the premium is fixed for that amount of years, 10 to 30 years. After that, the policy continues, is just the premium is not fixed. And what happens usually, people either cancel in that policy, obviously, because the premium jumps a lot higher and it will jump every year to a bigger number. Or they're going to choose it, write a new term if they're still eligible for that term. But if they had that disability rider and something happened and they disable, that disability rider will continue to pay for the premium. So ultimately, that term policy can become a permanent policy if the person became disabled before the age of 65. I would recommend to add that on both on the term rider because you never know what could happen, and ultimately it can have your policy convert to a permanent. It's not literally converting. You're still going to have a term policy, but that term policy means that your premium is fixed for a certain amount of years. After that, the policy still continues. But if you have that rider and you disable, you don't pay for the premium. So ultimately, you're going to have a permanent coverage, right? That's one. And you also can turn this policy, the term, you can turn to a whole life policy during that term, by the way. No medical will be required as long as you keep the same coverage or less. So you can do partial rollover, you do full rollover of the of that number. And if you had that disability waiver, it can also be applied to the whole life policy because you cannot add that waiver without additional underwriting if you didn't have that rider before. Again, if you have a decent health, then it should not be a problem. One moment. It should not be a problem. But if you don't, and and adding that rider would not be possible because you would not be approved. So on the whole life policy, why I recommend this rider? Because the premium usually higher than term policies. And again, the person is disabled, they might not be able to pay that premium, obviously, because they don't work and even they gain in some disability benefit from Social Security or disability policy. It's still not enough. It's still only partial substitution of the salary. So most likely the policy would lapse and all these years that they put into the whole life policy kind of will be pointless, right? Because the policy can exist for some time, but as soon as cash value would be exhausted, then the policy will lapse. So that waiver of premium for disability helps to keep this policy going. Again, it can be added at the beginning of the application, not in the middle. The person it can be run only up to the age of 65. After that, you're not charged for that disability rider and you don't have it. So the disability has to happen before the age of 65. A couple right another rider I would recommend to add will be the rider that for child policy. So when we set up a policy for a child, which recommended to set up obviously not the term but the whole life policy. Very common. A lot of like instead of putting this $20 to the savings account, you can actually pay for the whole life policy that will generate the dividends and instant coverage, and that benefit obviously will be growing. So it's a very common to set up for the parents and for each child. It's the least expensive whole life policy they will ever get in their life. So usually it's $25 a child to cover 25 or higher death benefit. So the rider for that, there is an insurability, guaranteed insurability rider. So when we put a policy for a child, please make sure that we include in that guaranteed insurability rider. That means that child, as he growing at the age of 17 and every 3 years after that, up to the age of 49, they will be able to get more insurance with no underwriting up to the amount that of original policy. So for example, if we did 25,000, they will be able to get another 25,000 during 17, 20, 23rd anniversary. Also at the events, life events. So for example, they get married or they have a child or another child. So during those life events, they will be able to obtain another policy with no underwriting. This is very important because there are some diagnosis that comes along down the road. It's not at the beginning of the life. And basically we bind that and guarantee that insurability for the future. Usually that rider is not expensive. It's maybe $1 more a month, and it's totally worth to add that on any child policy that is set up. Any child up to the age of 13, the parent can sign, but starting from the 14, we're going to need the signature of the child as insured. So how do we come up, right? What is our formula? How do we recommend as far as the coverage, right? So we actually have this formula that calls LIFE, right? So it's easy to remember. It's LIFE. So first one is L represent liabilities. What liabilities means? That's what we went before as far as this curve, right? Liability is mortgages, any liens, anything like that. So any loans that customer has, that's their liabilities. The next one is I. And by the way, when we talk about the liabilities, we're asking what is, for example, if the person has a mortgage, how long does the person has mortgage for? Is it for 20 years? Is it for 30 years? Or they have 10 years left? What's the balance on that, right? So we want to know the balance and the length of that mortgage. So basically, why? Because if the person has mortgage with that bank actually owns the property until the mortgage is satisfied. So what that means, if the person passed away, then this loan is come due and the family has to pay it. And most of the time, they can't pay it. And it's a big amount of money, a big chunk of money that they will have to come up or qualify for the new mortgage to get this mortgage fulfilled, right? So a lot of times families get a term policy to cover that loan, right? And you can get the easy one with a flat benefit of, let's say, 500,000 to cover 500,000 loan, or you can structure that as you paying off the loan, your coverage will decrease, right? So we're gonna just add a couple of riders we do the term 30, then add the rider term 10 and term 20. So, and basically the coverage will decrease as you paying off that mortgage. That's or you can just take that flat amount, and this way and you can always ask to decrease that coverage. You just call the office and we will send you the form. You sign the form and your coverage will be decreased. There is no underwriting. Anytime you decrease the coverage, nothing happens. You just sign the form and it's easy to process. If you want to increase the coverage, then the underwriting comes back and will ask more questions about your health, right? Because the life insurance depends on your health and on your age, right? So the first one is liabilities. The second one is letter I, which stands for the income. It takes regular family 3 to 5 years to adjust to new financial flow. So that's why we recommend to have from 3 to 5 times of the salary. So we first explain this formula to the customer before we asking any income information, because a lot of people feel that it's private, but when they know why we're asking, right, well, the reasoning behind it, just so we can help them to calculate what's their exposure, right? How much coverage do they need? Usually they okay to give that information, so we can calculate for them and suggest certain products. The third one is letter F, which is funeral expense. So we illustrating that it costs 10 to 25,000, but some families actually have funeral costing $50,000, right? So it depends on the family. So, but basically the range is from 10 to 25 for basic one. But there are some families that do a huge funeral, and it costs more. So we're asking, what is your plans for the funeral expense? Do you want your family to pay out of pocket, or do you want this insurance policy? We're talking about it, about that whole life piece that we have out here, like how much do you want to have no matter what happens. So, and the last one is educational, or E for education or other. So so education. So that means if you are planning to pay for your children education, we're asking a question: are you planning to pay? Are you planning to, let's say, create 529, which is educational plan for your children, educational investment plan for children? So if they say yes, I am, we're asking them, are you planning them to go to the state college or some private university? Because there is a big cost difference. For state college right now, the cost is about 25,000 a year. But for private colleges, it can be 100,000 a year or even more, right? So it depends on what college their parents want their kids to attend and allocate towards their education. That's a different protection that we are looking, right? So if they say no, I'm not planning, they're not going to college, or I'm not planning, they can take loans, we don't need to include this E. So basically, we're analyzing this whole formula for every family to see what needed. Some people don't have mortgages, they don't need it, but they do depend on each other income, so they need this part. Some people don't have funeral expense. Some people say, I prepaid my funeral, so they might not need it. And again, with education, other stands for charity. Some people want to leave money for charity, right? And I want to leave 100,000 to my university that I attend because I love it so much, or anything else, any other cause. So anything else, that would be letter E, representing here the additional coverage that that family needs. And that's how we calculate how to protect your family. And this is our contact information. I'm ready for your questions. You can call me and connect with me or my team, and we will be happy to assist you. Or COP, regardless of the ownership type. It's the same type of the policy.